name is Matt Taback. I work at both GTS and RADKL. I trade traditional, I'm a market maker in traditional equities, and I have been for over 2 decades now. And on the RADKL side of things, we trade crypto, both for counterparties and proprietarily. Guys, if we could go through, everybody give us a quick little intro. Tell us about who you are, where you work, what you do. I think it's on.
Hey everyone, this is Cole Kennelly. I'm the founder and CEO of Volmex Labs. We've built the first crypto volatility index for Bitcoin and Ethereum and built out a number of derivative products around this index. It's great to be here.
Hey everyone, my name is Ben Friedman. I work as a senior quantitative DeFi trader and analyst at Manifold, and we are a delta neutral hedge fund. And yeah, I spend a lot of time monitoring and observing our proprietary systems as they conduct trades, making sure everything stays within risk parameters, and conducting research, as well as making sure that our accounting team knows exactly what the heck we're doing with coins named after food items and animals. So great to be here.
My name is Shiliang. I'm with LedgerPrime. We're mostly quantitative, systematic fund, purely crypto. Do a lot in like derivatives, doing more in DeFi. Yeah, happy to be here.
All right, so let's start on the quantitative side of things. So with obviously the market insanity that's happened over the last few months, Terra, 3AC, as you know, at trading firms, how has that sort of changed how you think about risk and risk, not just risk management, but also sort of the freedom you may give your traders, to apply their trades?
Sure. I'll go ahead. Yeah, so the biggest lesson, I'm sure that everyone can agree from the Three Arrows Capital and Terra blowups of late is biggest lesson is tail risk is almost always undervalued. People get overconfident and they don't consider that there are weird things that can happen, especially when when liquidity dries up, it dries up fast. So one of my biggest concerns to that is I like to think of myself as the guy who, when one of my coworkers has a brilliant idea, I press on every possible tail risk that we need to be aware of. So, we want to, be involved in GMX's GLP. Great. How can it go wrong? What smart contract risk is there? What problems are there if everyone just starts aping into one side of the pool? How do we make sure that we're continuously hedged? And that's just a generic example that I'm sure people are familiar with. But yeah, these kinds of things are paramount to our risk profiling. And so on every single one of my write-ups of our trades, I make sure that everyone knows and we have rapid response to any possible disaster scenario.
Yeah, I mean, I would concur. I think, like, as someone that went through, I mean, crypto right now is kind of undergoing like the equivalent of a 2008 moment. It's like a credit crunch as a result of everything that's been going on. I think for me, having gone through 2008 and traded through it, I think it helped me at least just manage the firm from a risk perspective and just understand the kind of tail risk. I think, like, even though we're a quantitative firm, it's also systematic algo. In crypto, it's such a nascent field. That there's always going to be human input to it, because like if you just let the systems go, it probably would have like dumped all this money into like Terra and whatever, and like when it was depegging, because there's just a ton of arbitrage opportunities. And so it's there's a lot of context within crypto that is missing if you're just purely letting like a system drive things. And I would agree. I think like a lot of times it comes down to just like probability, right? Using like one example, as Terra was kind of depegging. The thought process was kind of just, well, like this is either going to blow over or it's just going to completely go to zero, right? But like it's not going to like bleed to zero over 5 months or 7 months, right? And so like at a given instant, it's kind of like, well, goes kind of like depegging to like 95 cents, 90 cents, right? And then it becomes more like a trade. Like, yes, like the cost of borrow is extremely high, but it was more of just like, well, it's like a 2-day trade basically, right? It's going to be zero, it's going to live, and it's going to go on. And so at that point, it's just like, well, it's an option, right? It's kind of like, it's either going to go back and lose 10%, or you're going to make like 5x, 6x, 7x, right? And so that was kind of that was kind of the thought process for us as we were kind of hedging our book out. So it's those scenarios where it's very like unique to crypto. Yeah.
I think the expression where there's smoke, there's fire. When it comes to crypto in traditional markets, you don't necessarily completely withdraw from the marketplace, and even in 2008 during the financial crisis, people didn't completely withdraw from the marketplace. But in crypto, I do feel from sort of a risk management perspective, anytime there's smoke, you might as well just completely withdraw. If you miss a trade, fine, but you don't want to be there if the whole building burns down. And so for us, surely we tend to act quicker on less information than we would in traditional markets, which is for us, very unique for crypto.
Something to add here is that a lot of the stuff that was going on with a lot of these centralized companies and entities was very opaque and unclear. And at least with the Terra situation, it's fully available and publicly available in DeFi, and people could kind of assess what was going on. So I think that's something to think about, not as much on the risk management side, but more on kind of how the product works. And so from the quant side, I think that's very interesting for them.
Okay, we have an addition. Would you like to introduce yourself? Tell us a little about yourself and your company.
Yeah, hey guys, this is Eric from Injective Labs, the co-founder and CEO. Brooklyn traffic was insane. And yeah, so we're core contributors and software development firm for Injective. And Injective is an open interoperable blockchain network focusing on and hyper optimized for DeFi applications.
So I guess we could even shift a little to that. So obviously this ecosystem is growing rapidly. The tools that we all have to trade constantly change, and the innovation with which they change is faster than anything I've ever seen. So let's talk a little bit about what is the next iteration of tools for trading, and what would you what's coming down the pipeline that you know of, or what would you like to see? Any volunteers here to go first? Yeah, please.
So I'll kick it off. We're obviously super biased at Volmex Labs, but we think crypto volatility indexes and crypto volatility derivatives are going to be a major trend in the market over the coming months and years. We have a number of exciting releases. We've launched a first product and index, and have some major improvements coming to the user experience and some of the things we've built out. So I think tracking volatility with crypto volatility indexes and will be a major tool for a lot of crypto traders. And generally these derivatives are very useful as well for speculation hedging. So definitely think that's a trend to keep an eye out for.
I guess one of the elements of tooling that I think probably will be coming down the pipeline is, as people know, centralized exchange, decentralized exchange arbitrage is a part of a lot of high frequency trading, and quantitative hedge funds like to be involved in that. And it wouldn't surprise me if a major centralized exchange or a group of them, I don't know, potentially FTX, they like to be on the forefront of this stuff, starts to offer institutional clients the ability to trade on their platform, and then simultaneously they can funnel liquidity to major dexes. So again, I'm really kind of hypothesizing here, but it wouldn't surprise me if that kind of thing comes in the future, or if somebody builds a product and then sells this as a service to other firms rather than just having their own in-house tooling to do that.
Yeah, I would say like a couple of very exciting things that could kind of evolve over time, especially as there are more potentially regulatory kind of clarity and on the definition of exchange and how they should operate, and overall expansion of DeFi infra and maybe even CeFi infra is you might start to see somewhat of a separation between clearing and settlement versus the matching. And one possibility is that, and actually a lot of custodians started offering that, is that basically enables for a deposit and withdrawal assets very, very quickly between different integrated platforms. And this could very much be transferred or transformed into kind of like a risk sharing or like a clearing layer where you can theoretically, obviously we're all talking about hypotheticals, collateralize with certain assets on a certain platform, and using that as kind of like a credit to interact with other exchanges and so forth. And this is actually kind of like how the current like centralized traditional finance operates, where you get to have very, very much capital efficient margining and also like collateralization, where the overall liquidity, if the assumptions hold, can be extremely well utilized in a sense. But also a lot of things do go wrong with those models, and generally, the brokerages and the prime folks like pay the cost on any type of fundamental failure, but it does ensure kind of like the final solvency of the clearinghouse and so forth.
Yeah, I would just add, I agree with that. I think like overall, like we're just really starting to scratch the surface within crypto in terms of like capital efficiency, right? Like you trading like GTS, I'm sure you see it, but like crypto trading is extremely capital inefficient. And like especially DeFi is like ridiculously inefficient. But even like centralized derivatives world is also very inefficient because like none of it's like fungible right now, right? It's not like I'm trading on Deribit or Bit.com or like none of it's actually like fungible across like different platforms. And I get that everyone's like kind of building towards that, like whether you think like a centralized exchange or a lender or an OTCS, like the holy grail is kind of like this prime broker model that everyone's kind of working towards. But I think like, we'll start to see like a lot of that, right? You'll probably see like some DeFi repro product. You'll start to see like, margining on chain, MarginFi is working on that, and like other products like that. But like we're kind of, to a certain extent recreating the financial rails, but a big problem, that's worth solving is just like capital efficiency. Whether that's starting with like lending and borrowing or whatnot, but that's something that we'll definitely see a lot more projects and focus on going forward.
Not to get too far off topic here, but I think a lot of these sort of things coming into the space might require giving up some privacy and anonymity. So do you think that it's worth it? Or do you think privacy and anonymity is critical to the whole ecosystem?
I think it's very critical for the overall ecosystem. I think as a trading firm, institutional trading firm, I don't really care. Like I'm just trying to make money for my like whatever. But like for the overall ecosystem and like what it represents, I think it's very, very important. And when I leave the space, I would hope that that is what ultimately prevails and comes through. I think we can all agree that like what's happened over the past week and whatnot is pushing the industry. I don't think it's completely comes as a surprise, but I think we collectively are here today not because we're here. We're just to like extract value, right? I think we whatever your path is to this space, I think it probably came from a more like privacy and angle or whatnot. So
yeah, I think privacy can be pretty differential and up to the user's preference, because essentially you technically do get privacy by consigning your information to a trusted party where they act as kind of like a source of truth. It almost feels like like a ZK solution in a sense that way. But that being said, that you're also consigning the power to them, and this is how traditional finance work, for example, and this is how CeFi currently works. That being said, people have the choice to interact with like permissionless, privacy-focused solutions out there. The recent Tornado Cash, incident is also kind of, expected in the sense that, government agencies, or in kind of like a abstract way, or like not getting too philosophical, is that you're kind of consigning like the value to the government, and so you have to adhere by their rules in terms of how it's supposed to be transmitted and whether you can even use it or not. And the fact that USDC, USDT, and all the subsequent arrests is essentially their way of telling you like you have to pick a lane. Like if you want to stay within the anonymous world forever and interact with each other in a pseudonymous or anonymous way, you will never be able to bring that same asset into like a custodial or like a trusted platform. Unfortunately, right now the world that we live in, it's always trust, credit based, and custodial by nature. So you're going to see like a more and more clear line in terms of privacy preferences for users, and they're going to see more and more of a kind of pros and cons, where the cons are going to augment even more as more and more regulatory actions within different government bodies' power trying to isolate that layer.
Yeah, I think credit certainly makes markets more efficient, but there's a price to pay for that credit. And I think, to your point, I think everybody will have to choose how far they want to go with that. And I imagine there will be different options for different use cases. And at the end of the day, to quote one of my colleagues, that's crypto has a way of bringing together people with diametrically opposed views, which ultimately is what trading's all about too, right? The buyer wants to buy, the seller wants to sell. It's a risk transfer, and it's really the same. It's like almost like a natural law. Do you have something?
Yeah, I mean, I think that fundamentally, massive component of crypto's value is this privacy, trustlessness, permissionlessness, and yeah, I mean, trying to put it does feel like trying to put a round peg into a square hole in a lot of ways, to graft some of this traditional financial rails onto a system that really, from first principles wasn't designed for it. But I think it probably is necessary. And yes, ideally, like you said, having this sort of divided ecosystem where you can exist on the bottom layer and be doing your stuff privately, versus the official doxed and fully compliant organizations and companies. Yeah, it's probably the best way to move forward for crypto, although it's a little bit sad to think, oh yeah, well, we're just gonna slap this veneer of regulatory compliance on, and then everyone who wants to play with the big boys will do that, and then the cypherpunks can go stay in their lane.
So going back to trading, this is a trading panel after all. One of the hardest things for any trader is to make sure that whatever it is they're buying or selling, they can achieve the best execution possible. And in traditional markets, this has been a focus of regulatory intervention, and whether the regulators over the years have made the quality of the executions better, or whether they've built rules that have made liquidity more robust or not. We could debate that forever. But in the land of crypto, do you feel like anybody can achieve that goal of best execution? Do you think there's a good way to measure it? And or is there some sort of innovation that's missing as of now?
I mean, I think it's definitely like a difference between institutions and retail, right? And like a lot of what crypto is or has been, it has just been arbitrary, like regulatory arbitrage to a certain extent. Like for us as a firm that is offshore as well, we can access global markets. We can access DeFi, various offshore exchanges, onshore exchanges. And so we like to think that we're getting, pretty good execution. But if you're like a non-institution or even an institution that can't necessarily create an offshore entity, you're getting a very vastly different price sometimes, depending on the jurisdiction and regulatory regime that you're executing under. And so, maybe you're getting best execution based on your kind of framework or what you're able to achieve. But at a certain extent, a lot of the difference that you see in the trading markets in crypto is really based on regulations, right? Like an example is just like, back in like Q2 of last year, there was like, it was the height of the bull market, like cash carry rates, like futures rates were like 30, 40, 50% plus on like Bitcoin and Ethereum annualized. But there's a huge difference between CME markets and like derivate markets. And they persisted for a while. And a lot of that really was just down to the fact that like you have very different institutions and traders accessing those markets, and a lot of the times that capital couldn't flow freely between a non-regulated entity like Deribit and a regulated entity like the CME markets, right? And if you were just doing directional strategies, you were getting vastly different price on Deribit versus CME if you're just trading the futures markets. So I think a lot of like what you see in terms of like execution comes down to like regulation, like Korean markets, right? Like the spot markets in the height of like a bull market is like trading 10, 20, 30% premium, versus elsewhere, and that's really just due to capital controls.
Yeah, I mean the same way that if you want to go buy an ounce of gold from some shady corner store, that they're not gonna care. It's just the guy who has the gold coins. You may pay a premium versus buying GLD on the stock exchange or whatever. The same thing is true, to your point, that if you are trading in the regulated space, you're going to get the benefits of regulation, or you can go to your friendly neighborhood illiquid DEX and pay whatever the automated market maker says you're going to pay. I do like the aggregators that have begun to crop up that try to get best execution for people, and I think that it would be good to see those kind of more publicized, and that more retail traders are aware that those things exist, rather than just market buying on Uniswap or whatever for what they're looking to get. But yeah, I think that sort of to that kind of two-lane with a dividing line in between the regulated and the unregulated side. The regulated side, absolutely, I think it's going to get more and more efficient, and people are going to get better and better execution as more and more of the major exchanges fall in line. But there will always be the option, if you are willing to pay the premium of worse execution for trading on those less liquid dexes, and there will probably for a very long time to come be arbitrage opportunities there for people who are willing to jump that regulatory gap.
I agree. So a healthy derivatives market certainly makes spot markets more liquid. Are we happy with the current state of derivatives markets? I will go to our Volmex first because, well.
Yeah, great question. So, the state of crypto derivatives, perpetuals are still largely, by an order of magnitude, the largest, type of derivative. The options market is a lot smaller, but, definitely growing, and also, growing in DeFi notably. So, I think, yeah, CeFi is still the lion's share of the derivatives market. DeFi derivatives are still comparatively very small, but there's massive upside there. We're obviously super excited about that at Volmex. I think, perpetuals options will continue to grow in DeFi. Other types of derivatives like volatility products and derivatives, and other different things. So, but I think, volatility products are very intuitive and will be a big trend as, things continue to ramp up. And ultimately, DeFi derivatives will definitely be bigger than CeFi derivatives in 5 or 10 years, and just a matter of time and, a few other things. But once the kind of liquidity is at parity, it will make a lot of sense to use DeFi versus CeFi, because there's, no counterparty risk, and instead there's smart contract risk. So I think, undoubtedly DeFi will flip CeFi, and on the derivatives front, and I think they'll be largely driven by perpetuals, options, and maybe some of the long tail products as well. But kind of that side of things. So yeah.
Any other thoughts on derivatives markets?
I can't wait for them to get more efficient and for there to be more out there.
Yeah, I mean, like currently the biggest problem with the overall derivative market is that it's heavily like segmented, and the world will be much better off if there's one global derivative market with aggregated liquidity from all those top derivative players. And the even more interesting thing is that they all offer different types of products in a sense. There might be differences in markets. There might be differences in margining calculation, where the value of a certain perpetual position or an option position is completely different, or might be pretty significantly harder to price across exchanges. And there's no better solution. There's no perfect solution to solve it within a snap of a finger, because it's a global competitive market. And the current state of derivative platforms and all these like global exchanges, they're all kind of just playing ping pong with like local regulators, where eventually you're probably going to reach a state of saturation where liquidity is going to be even further fragmented with local isolated wall garden books. Within different jurisdictions, where different styles of options, different styles of perpetuals are not going to be the same. So you can't even share liquidity in any like a feasible way across border. And I mean, like there is a clear solution for this, but like it's going to take a while for like people to finally adopt that, because those who were to adopt it would be giving up revenue, giving up market share, and so forth. And that would be theoretically using DeFi infrastructure or any type of smart contract layer as like a final settlement layer, because theoretically speaking, currently, for example, if you ignore like the 30 bips fee, technically Uniswap has the largest spot liquidity beyond like a certain size in terms of slippage. And that's purely because it's a fungible, it's a composable liquidity outlet, and you're just going to see more and more of that, like where either DeFi as a space and grows fast enough where it becomes like a formidable force, but in an idiosyncratic nature, or CeFi jumps on and kind of works together on it.
So a worldwide order book.
Yeah, I mean, like that's what Injective is kind of building,
though, right?
Yeah.
Not for everything.
Yeah,
every asset should move to that.
Yeah, I mean, like theoretically, that's what Injective is building, but obviously, like that's a very, very like epic goal. Like you got to start somewhere, and even though like a blockchain is slow, that doesn't mean that you can't have like a delayed final settlement layer for these type of orders and dynamic liquidities, where you could have interstate matching, just like any brokerages, as a matter of fact, but then print the final layer into, let's say, some clearinghouse style, which that's literally the nature of a blockchain itself.
Yeah, it's interesting. Okay, we've got about 15 minutes left, so let's open it up for some questions. Any questions? Yes, please, in the back.
So I think we're kind of seeing like a trend of like TradFi creeping towards DeFi and DeFi creeping towards like TradFi, and I think you're kind of like a microcosm of that. I'm wondering if you have any like color on like your experience going from, or going in between rather, like that TradFi world and like the DeFi world. If there's any like stark differences or interesting overlaps that you weren't expecting, or something like that.
Yeah, sure. So I am hopeful that sort of the beauty of crypto and DeFi is that it's had this opportunity to evolve and grow without the invisible hand of regulation, and we've come up with some. I have nothing to do with it. You all have come up with some incredibly innovative ways to do things, and I think that innovation has still a long way to go, and I'm hopeful that more people in traditional markets will recognize all the good of it, and at some point start to evolve traditional markets and to take advantage of all this great innovation. I mean, that is what I would like to see. On the same side, because of the freedom that you have in the land of crypto, you can release a project that is half baked, that creates a tremendous amount of risk, and that doesn't do anybody any good at the end of the day. So I think on the DeFi side or the crypto side, I'd like to see, um, you know, for lack of a better term, more responsible behavior, and on the traditional side, I'd like to see more open minds, and yeah. Anybody else care to add anything? All right, next, any other questions? Yeah, please.
Hey guys, I'm working at Arrow Markets, DeFi options on Avalanche. Something that we've learned over the course of the last year is to evolve options beyond retail, right? And for DeFi options to become more popular among institutions is capital efficiency and cross margining. So for DeFi, what do you imagine are like reasonable, pragmatic ways of having capital efficient, like call writing or just capital efficient derivatives trading margin?
I'll leave that to you guys, my options experts. Looking at the options. Anybody?
Yeah, I mean, I think like, I mean, you can introduce one way to do it is potentially introducing centralized rails, right? And you can round up like the lenders out there, the Genesis or I don't know, the next, basically like crypto lenders, and you can have them through DeFi rails inject repo like or lending markets, and provide leverage. That's one way to do it. It's maybe kind of half baked, or it's not the true spirit of what DeFi should be, but that is one way that could work, because that's basically kind of how it works now, right? Is if you're a trading firm and you want leverage, and I'm analyzing options protocols and whatever exchanges, etc. on DeFi, and it's, let's say, fully collateralized. Well, how do I reasonably justify, putting capital there, right? And one is, get incentives, sure, but like if I can actually access like cheap credit elsewhere, then maybe it starts to make sense, right? If I can get uncollateralized borrow from XYZ, then fine, I'll do it. But another way eventually is potentially you start to have like, I don't know, the LP tokens, let's say on Arrow Markets or Friction or whatever, all these options vaults out there, and they become fungible collateral that you can use elsewhere, right? Like you have this options position that you've acquired on a vault. It has some value, and maybe you can actually use that on Injective or I don't know, DYDX or something, right? And you want to like delta hedge it, and now like you have a short call and you've acquired like perps to hedge it, and in theory that's lower. You lower like the risk margining, and there should be more value to that, right? So that's another way that eventually, as all the protocols and rails come in place and start to speak to each other, that's more of a, I would say, like crypto native way of introducing, lowering credit, right? But lastly, I would just also say that like a lot of it is regulation also. Like in the U.S., you can actually have like under collateralized crypto derivatives, right? That's actually not allowed. Like on LedgerX, which is FTX US now, it's still a fully collateralized option. It's not like they can't technically do it. They're just not allowed to by the CFTC. And you can do it through the CME, through an FCM, but that's not like directly, right? And so if you're talking to U.S. institutions, you even if you could or wanted to offer like under like collateralized, leveraged Bitcoin options, you can't legally do it. So a lot of it is actually regulations as well.
All right. Any other questions? No? Okay. Well, let's wrap it up with everybody's, since it is a trading panel, favorite shitcoins. Who wants to go first? This is not investment advice. This is purely for your entertainment. You're first.
USDC.
That's a good one.
Everyone should buy big bags of Tornado Cash, because
If we all buy it, they can't come after us.
Exactly.
I was actually going to say Tornado. I mean, it's not. I mean, I guess like I really. Well, I mean, some names I like are like. I mean, I really like Maple Finance. I support it. It's not a shitcoin, I don't think. So it's it's a good project. It's a lot of like lenders, traditional like centralized lenders have blown up or have retraced in the market and no longer doing like under collateralized lending. So there's a huge hole in the market right now, where as a borrower you can't actually get like under collateralized, no collateral borrow anymore, because the market really doesn't exist post 3 arrows. And so you're seeing a lot of capital flow into Maple. And I think there'll be other projects like that, like Clearpool and others. So I think those are projects that we should at least, it benefits me, and so we should support.
I can't comment on that.
Come on. All right, mine is. It's also. I'm gonna like yours, Shiliang. It's not an indictment of what it is. Calling it a shitcoin. It's just a shitcoin because it's 7 cents, right? My favorite is the Shapeshift Fox token, and the reason is because they have an NFT project of this like the animals of crypto that the Shapeshift DAO owns. So by buying the Fox token, you own that awesome NFT project.